A very warm welcome to HYCM's workshop with myself, Giles Cochran, Chief Currency Analyst. Hope everybody's doing well. Jabeen, Josh, Obafemi, Warren, good to see you. Hope everybody is doing well. Looking forward to just taking us through the session, making sense of what's going on. I'm just going to quickly run through that CPI data with us. Don't forget, this quick disclaimer, this is not trading advice, it's an educational service, just to get that clear. So with the CPI data literally just coming out, what we want to do is we want to move straight over to the charts, and I want to just quickly show you the data that's in. Now, the CPI data has been really important, and the core was expected to come in at 4%, the headline expected to come in at 5.3%. Now, if we saw a big miss, that would have been a great opportunity in gold and silver. We haven't seen it, so we can relax. There isn't an obvious opportunity out of it, but I will talk us through anyway. The headline reading has come in. Now, the core's hit at 4%. The CPI year-on-year headline has come in at 5.4%. So inflation is pretty much as expected, and this isn't a big surprise to us, right? We know inflation is building. It has been for some time, and you can just see the headline prints here, year-on-year 5.4. If it was 5.5, 5.6, that would have been higher. 4% for the core on target, month-on-month, 0.4% slightly higher. So this, if anything, this should be like a slight negative. You'd expect to see sort of gold or silver fall, if anything, and then you have seen a little bit of that, but it isn't particularly tradable, right? This isn't an obvious trade. Gold and silver were both rising into the event. And the reason gold and silver were rising into the event was just simply on the fact that 10-year yields were pulling back. See that little pullback in 10-year yields? What that meant is that real yields were just able to move a little bit. I'll just show you. If you look here, real yields have been pretty flat. I'm using the Treasury Insurance Protected tip as a proxy for real yields. So real yields have been pretty flat recently, and seeing a little pullback in that was just helping to give gold a lift. There isn't massively anything tradable here, but that's just a slight negative impetus for gold and silver, with inflation being pretty much as expected, slightly sort of higher. So that was a good opportunity. I was really looking forward to that opportunity. If there had been a big miss in CPI, then you would expect gold to silver to absolutely rip higher. And I'll just explain to you what's going on. I hope you can see my screen and hear my voice okay. I hope this is all making sense. If you can't see my screen and hear my voice, let me know in the chat box. That's helpful. This is the big picture, right? Now, this is like Chris Capital. They are an investment bank group, and they've got a big precious metals long on. Do you know what I mean? And in fact, they're sort of a little bit underwater in their fund this year because they're so heavily biased towards metals, and they've got a real bias for precious metals running high. Now, this is the reason. You can see that gold generally tracks inflation. I'm sure you've heard that gold is an inflation hedge, right? Now, the only problem, and the problem you have to be aware of, is that gold is not just driven by inflation, it's also real yields in the dollar. So trying to make sense of gold, what you need to do is you need to look at this chart here. By understanding what's going on, let me just show you. By understanding what's going on here with the dollar and real yields, you can track gold prices. Now, gold prices, right, they're here with the golden, that's gold prices, right? Dollar index is red and tips is blue. Now, what you want to notice is when you have real yields or tips moving lower, and here's the code for you to use in TradingView. Grab this symbol and grab that, right? And then dollar index, that's just Dixie, DXY, easy. Now, when real yields and the dollar drops, gold rises. When real yields, right, and the dollar drops, so real yields falling, dollar falling, that's supportive of gold. So when real yields rise, so when real yields rise and the dollar rises, then gold has some negative. So you see here, Dollar rising, real yields rising, gold falls. If you look back here, real yields falling, dollar falling, gold rises. Then when you get the opposite, when you get the real yields rising, dollar rising, gold falls. And then here, real yields falling, dollar falling, gold rises. So what we want to see a really good scenario for gold, we want to see real yields and the dollar moving together. So that recent, now what's real yield? Real yield is just 10-year, US 10-year yield minus inflation expectations. So what real yield tells you is how much a problem or otherwise inflation really, really is, right? And that's it. And then that really helps you pick the pathway through gold. And then that helps make sense of a chart like this, which in and of itself, look, it is helpful a little bit, but it's not as helpful as seeing the real yields and the dollar on the same chart. So I hope you can understand that, right? Now, inflation is expected to move higher. This is a nice little chart still by Nordic Markets. And if you notice, when the planned price changes, NFIB moves higher, look, CPI moves higher too. Do you see the way it tracks it? So CPI should be tracking higher. So that's why it's not a surprise to see a little bit of an uptick in inflation today, right? That all makes sense. So, okay, look, that is now a key kind of risk out of the way. So let's look what else we've got. So at the moment, we've got a massive move in yen pairs. Now, let me explain this. Right. Now, the reason for this upside in yen crosses, think about it. All the central banks around the world are expected to increase interest rates due to inflation concerns. RBNZ expected to hike rates 4 times next year. Bank of England, we had Bank of England Governor Bailey Saunders talking about interest rate hikes coming. We've got the Fed expected to announce tapering in November, end of tapering by the middle of next year. Will they hike rates before then? Possibly. In central banks around the world are raising interest rates, but not the Bank of Japan. The Bank of Japan reduced or pulled back from a corporate tax rate hike. They're more likely to keep adding quantitative easing. So all of a sudden, there's a big rate differential. Now, this has meant that the yield spread between US 10-year yields and 10-year Japanese yields is just moving higher. This is all a massive support for dollar yen. Now, we don't want to get involved with dollar yen now. We don't want to be buying. Look, it's right into that resistance node. Hey, we get a pullback to 112. It's worth buying. So I think that's a great opportunity to potentially go long dollar yen 112, looking for a retest back up to 114. I took 3 trades on this. I took a trade with the break of the symmetrical triangle pattern into 112. And then after the pullback, I took another long back into 112. Then as this broke out high, I'll show you this little trick. Do you see how that broke above the key resistance? And do you see that candle? Do you see how it looks really beautiful and full and right up to the end? Look at candles like this. When you get this, it's a sign of strong impulsive continuation. Now, with the yield differential in place, this made sense to go long. And so I was long Monday morning and hoped to go long like with the break of 112.26 or in a little pullback. In the end, I came there on Monday and price was already up to like 112.50 or 30 or something like that. And I thought, you know what, I'm just going to go with it. And, you know, hindsight's a beautiful thing, but I'm glad I did. And I took profit 113 sort of 40 just into that overhead resistance. So these kind of like yield differentials, rate plays, what you're going to be getting on. Now, I'm not just showing you this to go, you know, look at me. It's not bragging. It's saying that when we have a central bank divergence, there are opportunities. And the Fed announced in September, remember that September Fed meeting? It was a surprise. Tapering coming, November. End of tapering by the middle of next year. Fast dollar yen upside. Now, this is being repeated across all the yen pairs. So I'm also long pound yen and New Zealand dollar yen. And I'll just run through that with you. Now, I'll show you the opportunity here that's also on the pound yen. Right. Sorry, let me just get rid of this bump. Right. Now you see pound yen, again, we had a hidden bullish divergence, price making lower, higher lows, indicator making lower highs. That's a hidden bullish divergence. So, as you know, I've been talking about this for quite some time, this chart, those of you who are regular. Now, that's up into an overhead resistance level. Expect profit taking up at that level. So that would be legitimate. But notice this trend line broken, that massive trend line from going all the way back to 2008, now broken to the upside, right? 1, 2, tested there. That's a trend line, valid, break, stay above. You expect that to keep buying. So in this pair, any retracements back down to, any retracements back down to 152, expect buyers. Any retracements back down to 153, expect buyers, right? So 152, 153, that looks good in pound yen. Now, Sonia futures are just showing that there are intense expectations for the UK to hike. Now, these Sonia futures, what they do is they tell you what expectations are for Fed hiking, for the Bank of England hiking. Now, you can see here, this is the U code 2022, U 2022, which is this turquoise one here. That is September next year. Now, the way you do these, calculate these, is you take the base rate of 100 minus the current interest rate, 0.10. That takes you to 99.90. And then, how far is it from 99.80 to 99.13? You just subtract 99.80, 99.13, and that gives you a 67, so almost a 70 basis point hike is expected by September next year for the UK. Now, whether that's moved too quickly, too fast is debatable, but look how quickly it's moved lower. In other words, interest rate hikes are expected to come. Why? Inflation concerns. That's what's driving the pound higher, right? So that means that any dips in the pound yen make sense because there's a rate differential between the UK and the Bank of England. So let's put on the bond yield spread now. UK 10 years minus Japanese 10 years. Put that on the chart. Let's do a new price scale so it's nice and clear. Okay. I'll tell you, I always get this code mixed up because it's a UK bond, but we're actually looking at Great Britain on the trading view. So now, hey presto, we get that. Now we look at the new price scale, get rid of the yellow one because it always messes up. And there we see, look. Now, if we just get rid of that pound yen chart, right, do you see how the bond yield spread is just broken out to the upside? Do you see how much of a rip it is? Right, that rip higher in the bond yield spread, that tracks the pound yen. Do you see? Look, rising yield spread, rising pound yen, falling yield spread, falling pound yen, rising yield spread, rising pound yen, falling yield spread, falling pound yen. You get it? That's the way it works. This is a rate move and a significant one. So this means that any dips are great for buying. So look for dips on pullbacks. I am long pound yen, and I took the perfect entry, just this symmetrical triangle, hidden bullish divergence, going along. Now I've got to make a decision. Do I try and go with it through this level, or do I take profit? It's tricky, you know what I mean? It's a great trade, but I really think there's more. So I'm not saying how I'll play it, but I'm just, look at that. And that's a symmetrical triangle breakout. So you would have the other way of playing this symmetrical triangle is 156 to 148. So that's 800 points. So the other way is 152. Look, that is signaling a move up to 160. Yeah, 160 is where I would be the next target. Interesting, right? Same with the New Zealand dollar, Japanese yen. Looking for that potential upside. Now, in terms of risk events that we have coming up, the other risk events we have are oil inventory levels. Now, if we just take a look at the oil inventory level, just have a quick look at the calendar. Now, if we see the daily risk event outlook here, you can see that the EIA oil inventory release is coming at 3 o'clock later today. Now, it's not there on the thing, just get this. Now, if it comes in a strong draw, expect more upside in oil. If it's a build above 3 million, expect some downside in oil, but expect dip buyers. Now, oil is very interesting at the moment, and I'll go through the reason. Right, oil is finding buyers strongly for 3 reasons. One, inventory levels are falling. There's been underinvestment in oil and gas due to green energy preference. That's coming to bite markets now. Secondly, COVID-19 cases around the world are falling. Vaccination levels are rising. Demand, therefore, for oil is expected to rapidly increase. Thirdly, OPEC has done a great job with their rhetoric about supporting oil prices. So this region in oil, that 77 handle, is ideal for buying. You see, it's a retest of that trend line. We've got a fundamental bias for oil upside. Any retracement back lower to that weekly pivot point, expect buyers around that 77 region. So risk could be nicely maintained just the other side of that. So look at that level. If we build an inventory, we might see some more downside in oil. If it gets as far as 77, expect buyers. Really watch out for that. Natural gas, absolutely key market. Now we've seen natural gas just finding a lot of support off this region here. That is a bullish pin buy. You can see that price is just moving within the body of the previous candlestick. You've got space to the left. The only thing is you're buying into resistance. So it's not necessarily a trade. But if you were looking to go long natural gas, then stops below the low. You want to look at weather. If weather gets cold, expect nat gas to keep rising. Very low gas storage in Germany, Europe. So any cold weather, expect nat gas just to surge higher. Let's see what else is worth looking at this week. Equity markets. Now, equity markets, if you're trading equities at the moment, you want to keep an eye on 2 things. One is the VIX. Now, as long as the volatility index stays below 20 to 21, then expect equities to remain supported. If it goes above 21, expect equity markets to fall. It's a very, very reliable gauge, okay? So if we did an overlay here, and if we just put in the S&P 500 over the top, you'll see, look, when the VIX rises, stocks fall. Rising VIX, falling stocks. Rising VIX, falling stocks. Rising VIX, falling stocks. Why? Because the VIX is just the volatility of S&P 500 puts in the option markets. So in other words, when traders are spooked, then you tend to see the S&P 500 falling as they're increasing their put options. So if this suddenly soars higher, then expect stocks to move lower. S&P 500 is a good proxy just for global indices. FTSE 100 is interested. If we can get a break and stay above that level there, expect more upside. So look for a potential break to the upside for the FTSE 100. We'll be looking for a move up there, filling that COVID-19 gap. That's a trade I like for the medium to long term. I am long personally for a longer term investment, looking for a move up to 7,500 in the FTSE 100. I really like it. For a quick trade, get above, stay with it, and get back below this level, close the trade. But a break of this trend line would look very nice for the FTSE 100. Let's just see what else. It's a funny week. It's a bit of this and a bit of that, but it's important just to keep your eye on things, what's going on. It's not unreasonable to expect major markets to pull back a little bit. So do look out for the yen pairs pulling back. but they are still very much a buy on dip, so pick the levels. Okay, folks. Yeah, going back to the main screen for a second. Now, here we go. You can see here, for those of you who just joined the webinar for today, remember the key thing what we're trying to do is back strength against weakness. And at the moment, the Bank of Japan is a weak currency because of its low interest rates. The rest of the world is starting to look stronger. That's why we've seen such heavy outflows in the yen. Also, the yen, Bank of Japan, the Japanese are a net importer of oil. So high energy prices impact and weaken the yen. It affects their balance of trade, right? So it's another reason for yen weakness. Okay, folks, it's been fast, it's been furious, but I hope it's been helpful. And I hope that just clues you into those main issues that are going on. Is there anything anyone's unclear of or wants a hand or a help with? Please do let me know. Looking for some retracement in yen pairs would be on now, and looking at buying those dips makes sense. Just keep on top of the stories. There was a bit of inflation seen in Japan recently, but not enough to spook the Bank of Japan yet. But it does tell you how much inflation is rising if even the Japanese are struggling with inflation. Expect that to be a big story. Oh yeah, there is one last thing I'll give you, and this will help you. You're going to be hearing a lot of talk out there about what high inflation, low growth, low inflation, high growth means. So just take a screenshot of this. It's a nice business cycle thing. So at the moment, what people are fearing is that we're going to have high inflation, blue arrow, low growth. That's called stagflation. That's what everyone's afraid of. Now the trade is long gold, long oil, long dollar. Now, if we have reflation, then that is the rest of the world growing. So that's high inflation and high growth. So that's copper, commodities, again, oil, pro-cyclical currencies, emerging markets, FX. As you see, dollar outflows would be generally it's dollar weak. Optimal growth, low inflation, high growth. And if it's low inflation, low growth, then that's disinflation. And that's when you tend to see bonds being lots of bids. A lot of bonds selling off now on this stagflationary environment. Folks, I hope that's helpful. And I hope that's just going to keep you in to what's going on. Any issues, just let me know. Okay, I'm assuming that everyone's okay. Don't forget, Monday, we'll get ready for the next week. It's important to pop into these webinars as I'll keep folks really clued into the narratives. A lot of changing narratives right now, potentially. So you need to be on top of the stories. You know, come here on Monday and I'll make sure we're on top of things and we don't get caught out. Okay, folks, take care, everyone. Have a really good rest of your week. Thank you, everyone. Goodbye. Thanks, Jabin. Bye.